For the latest in strategic affairs, subscribe to our YouTube channel. Click the bell icon for updates.
Did you know that India's gross domestic product suffered a record contraction in the first quarter of 2021? Did you know that this contraction was overestimated? And did you know that India's economic rebound post-COVID was underestimated? Last week, the Central Statistics Office, or the CSO, put out the latest numbers on India's gross domestic product. The headline number suggests that for the quarter ended December 2022, the Indian economy perceptibly lost momentum. But since the numbers for the previous years were revised upwards, such a simple comparison may be off the mark. To look under the hood, as it were, we spoke to Sajjid Chinoy, the Chief Economist India for JP Morgan.
So, GDP numbers are extremely hard sometimes to unpack. So let me try and talk about different aspects of it, because you can cut the data in many different ways. What is unambiguously true is that past growth rates have been revised upwards. So the contraction in the pandemic year was shallower than we had thought. The recovery in the year after the pandemic was stronger than we had thought. Even growth rates just before the pandemic year, even though below 4%, were actually revised upwards. So if you put all of these together, the best way to look at this is to ask yourself, at the start of this year, what was the level of GDP compared to the pre-revision level? And that level of GDP is about 1.3% higher, which is the sum of all the revisions in the last 3 years. So that's unambiguously good news, and there'll be no debate about that.
So what do we make of this economic data set then?
When thinking about how economies have recovered from these twin shocks, both the pandemic and the war, in India's case, it's more like a triple shock. There was a slowing down of the economy before the pandemic, and then the pandemic, and then the war. One way to judge how we're recovering from this is to ask the question, where are we compared to a pre-pandemic path? So had there not been these 3 shocks, or these 2 shocks in particular, what would the level of GDP have been, and where is it now? Now, the good news is that the shortfall is less after the revisions. Before the revisions, we were about 7% short of that pre-pandemic path. After the revisions, we were 6% short, but we are still short. So there's still some making up to do. Now, the second element of this is to ask what the current momentum is. So think of you driving a car, and essentially what the revisions have told us is over the last 3 years, our average pace, our average speed was higher than what we previously thought. But that doesn't answer the question, what's happening at this point in time? Are we accelerating? Are we stabilizing? Are we slowing? And that itself is a very tricky question to ask. Now, it really depends on, and this is a more technical question, how the NSO projects these growth numbers. Is it projecting and forecasting levels, or is it forecasting growth rates? If it's forecasting levels, then it is true that by pushing up the previous level, and the current level hasn't changed, the growth rate gets more depressed than otherwise would have been. If it's projecting growth rates by looking at a series of high frequency data and looking at the year-on-year growth rates, whether it's auto sales or agriculture or other things, then the previous revisions may not impact what your forecast is. So this comes down to a more technical question. I think the larger point is that after the revisions, growth was about 4.4%. Had the revisions not been there, the last quarter would have been closer to 5%. And so whichever way one looks at it, one has to say there has been some loss in momentum, which is perfectly understandable. I think we have to brace ourselves for the fact that with the global economy has begun to slow precipitously, the fact that monetary policy is normalizing in India and around the world, real rates are now 300 basis points higher than they were 2 years ago. And with the fact that fiscal policy is consolidating, some slowdown is inevitable. The question is going to be, when the global economy normalizes, when monetary policy and fiscal policy are at their steady state, what is India's medium-term potential growth rate? And we won't be able to answer that question just as yet.
Sajjid is right. The COVID shock has caused major alterations to the Indian economy. So what will be the post-COVID growth trajectory?
It's impossible to predict. I will say this, that there are clearly some very positive changes that have happened in the last couple of years, which I'm sure we'll come to. For me, what's really encouraging is the cleanup in balance sheets. For a decade, we used to talk about the twin balance sheet problem, where large corporates had too much debt, banks had very high NPAs and had become unwilling to lend. And the good news is that significant deleveraging has occurred, and therefore corporate debt to GDP today at the aggregate level is the lowest since 2006. That means balance sheets are in much better shape now for the next investment cycle. Banks are far more willing to lend. You've seen that through higher credit growth. NPAs are lower. So for me, that's a very encouraging sign that the balance sheet stress is behind us, and hopefully we're getting ever closer to a private investment cycle, which is a really important barometer of the health of an economy. The second piece of exciting news, I think, is what's happening on the services front, and the fact that post-pandemic, as digitalization has become more absorbed, more prevalent in the world, and because work from home has made offshoring more acceptable, you're seeing a huge surge in service exports. So just to put some numbers in context, net services every year used to be in the $80 to $85 billion range. That number jumped to 110 billion, and we weren't sure whether that would stay. This year it's tracking close to over 150 billion. Now, of course, it's 1 year. Let's see if this sustains. Some of it is higher services inflation, but there's no doubt that service exports have our market share is growing.
Sajjid is flagging a very important point with respect to India's exports. That is about the growing share of services in the export basket. I asked him to unpack this further.
So the good news is that the numbers have been very strong for the last 9 months. Unfortunately, we don't get too much of a breakdown. Here's what we do know, looking at the numbers top down. Some of this is software services, but a lot of this is IT-enabled services. A lot of this is R&D. So more and more multinational companies are in fact shifting and creating back offices and corporate centers in India to service their clients globally. And this is actually exciting, almost inevitable, because remember, around the world, working age populations are actually contracting, right? In many parts of the world. India's is the opposite phenomena, where our working age population is expanding and rising. So with the advent of technology and with work from home becoming more acceptable, it stands to reason why people would want to exploit this arbitrage and use India's workforce to service their demands overseas. If a company in New York is comfortable with an employee sitting in Ohio, there's no reason why they would not want to shift that headcount to Bangalore and pay a much lower cost. So this is a huge opportunity for India. Very happy to see and encouraged to see that we've been growing very rapidly. We need to be a little bit cautious to see to what extent will this slow as advanced economies slow in 23? What happens to some of these revenues as inflation comes down? But in my mind, there's clearly a structural element to this, which is very exciting.
One takeaway, though, from the latest numbers on GDP is the perceptible slowdown in consumption.
Anil, I'm not particularly surprised that this would happen at some stage. Timing is always hard to predict, because if you're of the view that you're still about 6% below a pre-pandemic path, then that will show up in the labor market. And if you look at some labor market surveys, you begin to see that. Even if you look at the RBI's own survey of employment perceptions, you can see that we're not where we were at pre-pandemic levels. And that's true of many emerging markets. And you also see that in qualitative descriptions within the RBI survey. So I know consumer confidence has picked up, which is a good thing. But when urban households are asked, what are your spending patterns? What is your spending perception today? and what will your spending perception be 1 year from now, both those measures, while they've improved, are still meaningfully below pre-pandemic levels. Now, consumption really is an outcome, right? And it's the last stage in the process. For me, we need an investment cycle that creates jobs, jobs that provide income certainty. And once you have that income certainty, you will get sustained consumption growth. So I'm very focused on investment. Now, again, the good news here is public investment is driving gross fixed capital formation. I think the government, central government, deserves a lot of credit for making this the leitmotif of the last 3 years, that we require a big push on public investment and physical infrastructure, because hopefully that will crowd in private investment. So I think while consumption is a little bit concerning, it should not be particularly surprising. I think if we can get the investment cycle started at some point and the job creation that comes with it, consumption will follow.
The good news is that for the last 3 years and more, government investment has not flagged. But the bad news is that this is a mere fraction of private investment spending. So, can the economic recovery happen without private investment kicking in? Remember, this has not happened since 2008.
If we look at total investment to GDP, it's close to about 31%. Of that, just a quarter or so is government investment, 7% of GDP. So if you break investment down, there are three main sectors. One is the public sector, which is central government, state governments, and PSUs. There is the household and SME sector. And then there is large corporates. Now, there's been so much focus on large corporates that we don't sometimes fully appreciate that if you go back a decade, the sector that's declined the most has actually been households and SMEs. So let's look at the prospects of each of these sectors. I think on large corporates, again, cautious optimism that what was holding back investment in this sector for the last decade was actually balance sheets. And as we discussed, balance sheets are much cleaner. However, we have to be realistic that this could still take some time to kick in. Why do I say that? Because if you look at utilization rates, capacity utilization rates in manufacturing, they're still about 73, 74%. Now, if you have to look at the global context here. At a time when there's unprecedented global uncertainty, worries that some parts of the world or the whole global economy could go into recession later this year or experience some kind of hard landing in 24, and the fact that interest rates are rising around the world, it's understandable why entrepreneurs will be patient and sit it out to say, until I have more conviction on global growth bottoming out, until monetary policy turns, we will be patient. So I think the good news on large corporates is balance sheets are in good shape. Demand is now the issue. And we need to be realistic that once the domestic and global slowdown is behind us, then hopefully we'll get an investment cycle. So that could still take some time, but we're getting closer. I think where some people are more hopeful is residential real estate. After a decade of malaise, we're actually seeing some very hopeful signs over there the last year. This is important because the multiplier effects of a real estate cycle pickup are quite large. But again, we need to be realistic. Some of this is because affordability picked up and we had not had a cycle in 10 years. And some of it is because monetary conditions were very accommodative in the pandemic period. Now that monetary policy has normalized, to what extent will that temper any real estate proclivity? So yes, we need to be realistic that the private investment cycle to be broad-based and sustainable could still take some time, though we're getting closer, which is why it's really important for public investment not to take its foot off the pedal. That we need for the center to keep pushing, which is why I thought it was really encouraging and important that the infrastructure thrust in the budget has been accentuated even further next year. We need more of this for many years.
Sajjid believes the private sector-led investment cycle is poised to kick in. But what about the gorilla in the room, inflation?
So there are two elements to inflation that we need to unpack. One is food and fuel, and it's clear what the genesis of that was. I think the Ukraine war, the fact that commodity prices surged, fuel prices surged, food prices surged, was responsible for this around the world. And the good news is that's abating. If you look at both commodity price levels have come down, food price levels have come down, and so you will see over time that at least the imported inflation momentum is coming off. I think the parts that worrying central banks more around the world is core inflation. That why is underlying inflation so strong? Now, again, this is much easier to explain in advanced economies. They gave huge fiscal stimulus. Demand was extremely strong. There's a lingering supply shock in the labor market. And so it's perfectly understandable why core inflation is going to be so elevated and so sticky. The labor market in the US, for example, is the tightest in 50 years. When there is so little slack, you will have inflationary pressures being sticky. So in the US, for example, it's quite clear what needs to be done. You need to slow the economy down. You need to generate some slack in the labor market, and the hope is that will translate into lower core inflation. India's inflation is a little bit more of a conundrum because, for the reasons we've discussed, we don't have that kind of tightness in our labor market, right? We're still some ways away from the pre-pandemic path. So why is it that core inflation has been so sticky for the last 3 years? And this is true of other emerging markets as well, not just India. So the good news is, our inflation rates at their peak never reached the levels that the advanced economy saw because of the sheer quantum of stimulus. But one thing that we have to address is the stickiness of core inflation. There seem to be two hypotheses here. One is, inflation expectations have hardened, and inflation is very much self-fulfilling. If people expect it will remain sticky. And the second is a more kind of intriguing proposition in some parts of the world, that the pandemic was more Darwinian. The large firms were able to absorb the shock better, and therefore they increased their footprint. Their market shares have gone up, and therefore they've had more pricing power. Now, this is still a hypothesis. There is no data to back this, but these are two hypotheses as to why you can have some level of slack in the labor market in India and still have very sticky inflation. I think, when this ends, Anil, hard to see, but I think the RBI deserves a lot of credit.
In the final analysis, it is clear that India's economic report card is a case of a cup being half full. The repair of the Indian economy post-COVID and resolving of legacy deficit is still a work in progress. But for now, the Indian economy is a lighthouse for the world economy. Thank you for watching. Do subscribe to Strat News Global on YouTube. Hit the bell icon so that you don't miss any updates. And please do share any thoughts, ideas and insights with us. I am available on Twitter at Capital Calculus. I'll be back next week with another episode. Till then, stay safe.